Warren Buffett is worth over $100 billion. But here is the thing most people miss. If he had started investing at 30 instead of 10, and stopped at 60 instead of continuing, do you know what his net worth would be? Not 100 billion, not 50 billion, not even 10 billion, just $11.9 million. The difference between 100 billion and 11.9 million is not skill, it is time. Let me start with something that happened 20,000 years ago. Scientists were confused for a long time. They could see massive glaciers, sheets of ice covering entire continents. But how did they form? Where did all that ice come from? The answer was surprisingly simple. Every single winter, snow fell. And in certain regions, the summers were not quite warm enough to melt all of it. So just a tiny amount of snow remained, just a thin layer. Then next winter, more snow fell on top of that thin layer. And again, not all of it melted. Another thin layer remained. Year after year, century after century, millennium after millennium, layer upon layer upon layer, until those thin layers of snow became glaciers kilometers thick. No single snowfall created the glacier. No single year made the difference. It was the relentless accumulation over an unimaginably long time that built something extraordinary. This is exactly how compounding works with money. Small amounts, consistent returns, unstoppable time, and the result, something most people cannot even imagine. Now let me tell you about Warren Buffett, the most famous investor who ever lived. Warren Buffett bought his first stock at age 10 years old. While other kids were playing outside, young Warren was studying companies and buying shares. By the time he was 30, he already had $1 million. That sounds impressive. But here is the real story. Warren Buffett is now 93 years old. He has been investing for 83 years. And here is the shocking part. 96% of his entire wealth was built after his 65th birthday. Think about that. He had been investing for 55 years by the time he turned 65, and 96% of his money came after that. His net worth at age 65 was around $3.8 billion. Today, it is over $100 billion. The last 30 years added more wealth than the first 55 years combined. Now, here is the most important question. Was Warren Buffett a better investor after 65 than before? No, his skill was the same. His strategy was the same. The only thing that changed was time. More time meant more compounding. More compounding meant an explosion of wealth that most people cannot comprehend. Warren Buffett himself has said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Let me show you exactly how compounding works, because the numbers will genuinely shock you. Imagine you invest just $100 every single month, starting at age 20, at a 10% annual return, which is roughly the historical average of the stock market. By age 30, you would have around $20,000. By age 40, you get around $75,000. By age 50, around $226,000. By age 60, are around $632,000. By age 65, around $1 million. $1 million from just $100 a month, starting at age 20. But now, what if you waited until age 30 to start? Same $100 a month, same 10% return. By age 65, you would have just $380,000. Same money, same returns, 10 years difference, but the result is 2.6 times less wealth. This is the brutal math of compounding. The early years look boring. Nothing seems to be happening. But underneath, just like those thin layers of snow, something extraordinary is building, quietly, patiently, unstoppably. So if compounding is so powerful, why do most people never experience it? Because compounding has one deadly enemy, and that enemy is interruption. Every time you panic and sell your investments, you interrupt compounding. Every time you pull money out for unnecessary spending, you interrupt compounding. Every time you chase the next hot stock and constantly switch, you interrupt compounding. Warren Buffett has a famous quote: "The stock market is a device for transferring money from the impatient to the patient. The impatient person sees their investment drop 20% and panics. They sell, they lock in their loss, and they miss the recovery. The patient person sees the same 20% drop and does nothing, or better, buys more, because they understand that time will fix almost everything in a diversified investment." Charlie Munger, Warren Buffett's partner, once said, "The first rule of compounding is never interrupt it unnecessarily. Do not interrupt it. That is the entire secret." So what do you do with this information? Lesson 1. Start today, not tomorrow, not when you have more money, today, because every single day you wait is a layer of snow that never falls, and you can never get it back. Lesson 2. Stay consistent. $100 a month for 40 years beats $1,000 a month for 10 years. Consistency over time always wins. Lesson 3. Never interrupt. Do not panic sell. Do not pull out for unnecessary reasons. Let time do its work. Lesson 4. Think in decades, not days. The stock market goes up and down every day. Over decades, it has never failed to grow. Zoom out. Be patient. You do not need to be Warren Buffett. You do not need to pick the perfect stock. You just need to start early. Stay consistent and never interrupt. Time is the most powerful force in finance, and unlike money, you cannot earn it back once it is gone. Warren Buffett did not become the greatest investor by being the smartest. He became the greatest by starting the earliest and staying the longest. The Ice Age glacier did not form because of one massive snowstorm. It formed because of thousands of small snowfalls over thousands of years that were never interrupted. Your wealth works exactly the same way. Start small. Stay consistent. Never interrupt. Give it time. That is what Charted Money is all about. Breaking down real money lessons into simple visuals so that finance and financial markets become easy for everyone. If this video changed how you think about time and money, hit subscribe. Because next week's Smakshu, we are going to talk about something that will completely change how you think about getting rich. See you there.